Once again, good morning and welcome everyone. It's just over 11 a.m. in the Netherlands, just past noon in Kenya, where one of our speakers is based. Just because we have a lot of interesting presentations today, I think it's best that we start. And if people join later, of course, it's open. And this webinar will also be recorded and made available via our YouTube channel afterwards. So if you've missed anything, that's where you can find it back. This is a session, of course, about managing currency risk in Africa. It's organized by NABC, the Netherlands African Business Council, in close partnership with StoneX, formerly known as INTL FC Stone, and TCX. My name is Maloe de Reuver. I'm a project manager at NABC, and I will host today's session. For today's webinar, we have some great expert speakers. We have Niels van Duinen, working for StoneX in Netherlands. Raphael Agung, who is chief economist at the NCBA bank in Kenya, one of StoneX's corresponding banks. Per van Swaay, working for TCX in the Netherlands, and Kevin Laryea, also working for TCX. So again, very happy that you could all join the session, to the speakers mostly, and provide us with your expert views on this important topic. And without further ado, I would like to hand over the mic to Niels.
Yeah, good morning, everyone, and thank you for that introduction, Maloe. So, my name is Niels. I'm very excited, first of all, for having this opportunity to be speaking to you, although it's just for a couple of minutes. I work for the global payments division of StoneX now for a bit over 5 years, and I think the best way to describe the company is as a global payment specialist. And besides us serving a large amount of corporate and charitable customers directly, we're also used by the majority of the global banks to settle payment in markets they do not have access to themselves. And a little bit about the company. StoneX is a Fortune 500 financial services provider listed on the NASDAQ and deals in a variety of different asset classes. But again, I'm really here to represent our global payments division, and we help our customers with settling cross-border payments in local currency, and by doing so, taking away any risk that traditional cross-border payments bring with them. So if you talk about currency risk, you often think about volatility, and in the context of this webinar, most likely the often depreciation of African currencies against the euro or the dollar. We'll hear later on from TCX, who are really the specialists in managing currency risks and hedging those risks with a variety of products, focusing on the long-term risk exposure that your organizations might be exposed to. But there's also the risks of sending euros and dollar cross-border on a spot basis. You have, for example, no influence on the path that your funds will travel, and no impact on any FX fees or rates that might be applied when funds arrive in country. So in the couple of minutes that I have, I just wanted to share with you a few points that I think are very important for you to think of when choosing a good FX spot deliverable partner, whether this is a bank or a non-bank. And the first thing here, I think is really key, is to make sure that they have a large correspondent banking network, especially multiple relationships onshore to access direct liquidity, but also have established direct lines of communication, having local knowledge and understanding to make sure that your payments don't get stuck for whatever reason. Think about the risks that you potentially take by maintaining your own relationships, for example, credit risk in communication, being connected to SWIFT and being SWIFT GPI compliant, for example, can make it much easier to track and trace your payments. But also think about the risks when you send dollars cross-border. What are the market risks involved, and will you receive the full amount when funds arrive in country? What are the risks of holding dollars or local currency, for that matter, onshore? Think about regulatory, maybe political risks, but also the potential risk of devaluation. You know, we've seen it happen many times, for example, that organizations got in a situation where they had funds stuck in Nigeria and absolutely no means of getting them back out. I think the point that I'm trying to make here is that one of the most important things when it comes to mitigating risk, whether this is on the short or long term, is finding a partner that is a clearly defined path of getting your funds in country, and next to that, it's very important that you have a partner that has a local presence when it comes to frontier marketplaces, and can be a partner that can help you with, for example, local regulation to settle a payment, or work with local regulators to register an investment property. And you know, if I take Nigeria again here as an example, there's a lot of speculation lately around, now, how long can the Central Bank of Nigeria keep propping up the value of the naira? You know, do you really want to end up in a position where you will have a lot of nairas on your balances as the currency comes crashing down? You know, my trading desk told me that they wouldn't be surprised if this would be more than 15, 20%. So in the end of the day, I think it's all about controlling the process and partnering with someone that has that control and can offer you transparency. And I'm emphasizing here that local currency can be delivered T+2 the latest, irrespective of the market. So no balances need to be held onshore. In other words, you know, just send what you need now instead of sending a lump sum for future needs. And institutions like ourselves really exist to demystify that process for you. You know, developing and frontier markets shouldn't be thought of as far-reaching. You know, they are easy accessible, and that is exactly what our role in the payment ecosystem is, you know, to facilitate access and efficiency. So on that note, please do reach out to me after this webinar if you have any question whatsoever about your current cross-border requirements and needs, and happy to have a conversation with you around any of the subjects that relate to that. I would now like to hand over the word to Raphael Agung, and I'm extremely excited to have him on today's call. Raphael is working for NCBA and is one of our principal correspondent banking relationships in Kenya, and will share his expertise on the East African market with me. Thank you.
Yeah, thank you very much, Niels, and good morning, everybody. Thank you, the Netherlands African Business Council, for convening us. I'm very pleased to join the conversation today. Obviously, Niels has given a very wonderful opener on the topic of discussion today, currency risk management within the African context. We'll all appreciate that the currency risks that we'll be discussing today will be derived mostly from the macroeconomic context of the day. So we thought it would be useful for me to provide a quick snapshot or overview of the macroeconomic context within the EAC, which is a very key part of the sub-Saharan African territory in terms of just economic parameters. So I'll do a quick 12, 14 minutes overview of what we've seen this far. So I think if you move on to the next slide, I'll provide a sort of summary of how we see 2020 closing in terms of overall macroeconomic outlook, and then give us a snapshot of potential 2021 recovery path as we see it. And then, of course, try and see how much of the attendant rates that I can outline that would, of course, be consequential to the currency discussion that Per and the rest of us will be going through. So one is to record that if you look at the broader sub-Saharan African growth, which I'm saying is SSA, it's averaged about 3 to 3.2% in the last decade. And the East African community, particularly Kenya, Uganda, Tanzania, and Rwanda, have remained the powerhouse for that sort of growth number that sub-Saharan Africa has recorded. As a matter of fact, the region has somewhat doubled this SSA average in a similar period. So pre-pandemic, what we've seen in the region is a very strong GDP long-term trend, averaging about 5.5% to about 9%. The fastest growth, of course, coming out of Rwanda, which is the smallest economy in the EAC, averaging about 8-9%, and then followed by Tanzania at just about, on average, 6.5-7%. Kenya and Uganda are pooled around 5.5 to 6% for the most part. For those who may not be aware, Kenya remains the largest economy in the region, followed very closely by Tanzania, very fast growing, and then of course Uganda, and then we have a tiny one, landlocked Rwanda. So the economic path that we've seen across the region has remained, at least it's important to talk about it in two ways, pre-pandemic and then of course into the pandemic, and potentially with and after the pandemic. So what I'm putting forward as the first point is we have seen very strong growth. This growth has been characterized by pretty much low inflation. For the most part, across all the EAC4, we have a fairly diversified economies. So unlike what, for instance, you probably are familiar with Nigeria and even South Africa, which is commodity-led, the broader EAC has a very strong cross-section of growth numbers coming out. Potentially, of course, the bulwark remaining agriculture and rain-fed agriculture, to be precise, but then, of course, very strong services and related transport, accommodation, and what have you. What's informed the growth, strong growth numbers that we've seen prior to the pandemic has been, of course, that performance out of agriculture broadly across all four, but also relatively, we've seen very rapid infrastructure expansion, particularly in Kenya and Tanzania, which is basically public investment in the area of infrastructure. We've seen lots of roads. Kenya has just done a standard gauge railway, and that has powered that growth outlook that you have seen. Of course, you would imagine that with that sort of public investment outlay, the fiscal capacity questions have remained lacking in the immediate horizon. So for all four economies, the policy implication has meant that fiscal consolidation as a policy priority has continued to inform most of public policy approach. And questions, of course, with the pandemic, it's only gotten worse because of the necessity to support investment in public health, which has, of course, markedly increased the deficits that we're seeing across all funds. This is true at least globally, so nothing new there. The only thing to point out is that the ability for each of these countries, starting with Kenya, to achieve the fiscal consolidation priority, which is a requirement for a stable macroeconomic environment, of course, which has implications for the kind of currency risk that we'll be talking about, remains somewhat uncertain given the realities of the pandemic. So for 2020, we've seen weakness across the board. So if we begin with Kenya, we've seen sharp contraction in the services terrain, particularly hotel and accommodation, just given the social distancing measures that had to be taken in order to address the pandemic, including lockdowns for the most part. For a significant part since March commencement of the COVID-19 pandemic, we've had drastic lockdowns and social distancing measures leading into sharp contractions across the board. And so remarkably though, even though around June, our focus had expected Kenya to contract to about -1%, which would be sort of unheard of since 1970. Well, what we've seen though is there was dramatic and very good performance around agriculture in Q1, because we now have Q1 official numbers, and the economy grew about 4.9%. That strong opening has somewhat forestalled earlier perceived contraction, and what we see, for instance, in Kenya is it may be able to close 2020 at 0.84% GDP growth. Tanzania is interesting for two reasons. One is, of course, it's a very rapidly fast-growing economy. It has a very huge resource base around minerals, particularly gold. But more materially, for these conversations, Tanzania, unlike the other three EAC countries, took a different approach to managing the pandemic. So rather than extreme lockdowns, I would say they were, and I'm saying this advisedly, Tanzania happened to be a little bit more lax. So in actual terms, they did not get into extreme closures of the type that we saw in Kenya, Uganda, and Rwanda. And for that reason, they seem to be closing 2020 in terms of GDP numbers fairly unscathed. As a matter of fact, their average growth numbers has been 7% prior to pandemic. They'll shed off just about 150 basis points to about 5.5, according to our internal forecast. Now, I need to state that these are baseline numbers. So what we've taken on the baseline is a presumption that Q4, because we've seen reopening, steady reopening of all these economies, and we are anticipating that Q4 economic activity will return at about 80% of pre-pandemic levels. So that is what gives you a baseline growth number of about 5.5% for Tanzania, and which would be remarkable given what we are seeing globally and particularly even in the African context. So, I mean, I guess there's been lots of criticism around the Tanzania numbers, particularly in their approach to the pandemic, but it would seem that for some reason, I guess unwittingly, it's paying off, and now will be something that is important to flag out. Now, Uganda is pretty much the nice tier case, if you will, of the four. I think it will, we project that it will contract by just 0.1% because of, again, the social distancing measures, extreme lockdown, but also a little bit of average performance in broader services, which is about 45% of that GDP. And of course, across the region, they're also benefiting from that agriculture liftoff. So we see that as the sort of number that you would want to look at. Rwanda is tiny, but has averaged almost 9%, as I said, in the last 6 to 8 years, coming out of very strong and steady management, macroeconomic management. But we think that just given the frozen nature of economic activity in order to address the pandemic, it will contract to about 4.2%, that's the slowdown. So in a nutshell, there is broad-based slowdown in growth across all the EAC4. We've seen policy responses that, of course, are consequential to the currency risk management conversation that Pierre will be taking you through. One of which, of course, on the fiscal side has been a massive support of households and businesses. So that, for instance, in the Kenyan case, we've seen tax reductions of at the payroll tax level of almost 5%, and similar business taxes reduced to 5%. So obviously what that suggests to you is, in terms of fiscal outlook, you're looking at not only are you going to see increased or widening budget deficits on account of revenue performance, but you're also likely to end up with a scenario where this begins to have implications for your interest rate outlook. And of course, that will inform some of the currency conversation that we're doing, so that we're going to have. So the situation is similar in Tanzania. Uganda's external side, similarly, you'll find that sort of a concern around fiscal capacity. Be that as it may, the widespread slowdown is a little bit better than we had expected, at least by the time we're having this discussion around end of Q2. So what we've seen from leading indicators on the economic numbers is a steady sort of recovery, which recovery we project will proceed in earnest towards the end of Q4 of 2020. And so in 2021, we see the potential recovery path giving us those sort of numbers, where Kenya rebounds to about 3.9 or 4%. Tanzania goes back to almost its long-term average of 6.9 or 7% thereabout. Rwanda gets back to pre-COVID levels precisely, and then Uganda is about 4.5. What's informing this is that, and we're not taking any specific views on whether there will be therapeutic or medical management of the virus. We are assuming that in the best case scenario, you get a vaccine widely available towards mid-2021. But even if that doesn't come through, there seems to be a determination, and we're seeing that on the epidemiological curve, there seems to be a determination to address it in ways that were perhaps not very clear on the commencement of the pandemic. So what we are seeing, for instance, the Kenya, Tanzania, and Uganda numbers, the curve is almost somewhat flattening. It's slowing down, and there is a determination for economic activity to return. The high frequency data that we see, including mobility numbers, is suggesting that almost literally across the sectors, there's return to economic activity of up to around 80-85%. And so that is a sort of post-COVID or with COVID sort of economic landscape that we see. Of course, this has implications for business models. So what we see, for instance, on the labor market outlook, in the Kenyan case being the largest economy, we are seeing a situation where unemployment rate has doubled to about 10.4% and is likely to stay that troublesome at those high levels for the duration under review. And that has implications, of course, for aggregate demand in the eventual analysis. So you don't get back to your 6% sweet spot in terms of GDP growth numbers for that country, for Kenya that is, but you sort of begin seeing that sort of determination to get back to stronger outlook that we've seen. Now, before I hand over to Para, I just need to say, and maybe as an opening to him, because he's going to dive into the subject of the day, is to just summarize and say the risks that we see from a macro standpoint. Of course, the risks to this outlook remain potential reinfection numbers. So a second round of COVID-19 could disrupt this macroeconomic outlook dramatically. That's one. In the region also, we have political risk somewhat lagging in the background. So for instance, Uganda is slated for its presidential elections in March of 2021. That has consequences to how you perceive the risk terrain there. Soon after, Kenya comes in 2022. Tanzania, of course, is closing its own presidential elections just end of this month. And so that tends to have some sort of vagaries on the macroeconomic performance of the time. We've seen reduced activity around election time across the region. So you have to factor in that. But the other risk, and again, I've repeatedly gone at this, remains, of course, the fiscal path and implications for debt sustainability concerns, particularly in the case of Kenya. You have a situation where the public debt profile has bulged dramatically in the last 6 to 8 months, and that has implications for Kenya's interest rate outlook. Currently, because of the monetary policy response to the pandemic, we've had steady liquidity, and that has suppressed the yield curve. So from a pricing point of view, and Per will talk about this in terms of just the currency risk management tools that we have, that's the sort of yield curve dynamic that you've had to address. We think, though, that the monetary policy path will remain flat into 2021 for the reason that there's actually the output gap is much wider than we anticipate, or rather we've seen in the past. And in order to deal with closing that output gap, they maybe need to continue with the accommodative monetary policy across the region, and which of course will also be very dependent on what happens on the inflation outlook. Inflation on average is 4.5–5% and below across the region. So that's a good thing. It suggests to you that there may be still some sort of oomph on the monetary policy side should the need arise in order to address the outstanding output gap, which is a key priority for macroeconomic policy. So I don't want to go beyond my time. I'm aware that we have a very tight schedule and lots of speakers after me, and so I will hand it back to Maloe, who will introduce Per to carry on with the conversation. Thank you very much.
Yes, great. Thank you very much, Raphael, for this macroeconomic outlook, and also already for making the bridge to Per's presentation. If there are any questions at this point already for Niels or Raphael, please post them in the Q&A function below. Then we'll now move to Per.
Unmute myself. Yes, so yes. I'm unmuted. Brilliant. Thank you very much. Thanks, Maloe. Thanks, NABC, for hosting. Thanks, Niels, for doing this with us. And thanks, Raphael. I thought it was incredibly useful and interesting. We also look, of course, at markets, at macro conditions. Here on the call with us today is also Jos Kramer, who heads our research department. And he will have been listening with great interest. However, we cover close to 70 or theoretically up to 100 markets worldwide out of Amsterdam with a single team. And naturally, our resources are incomparable to what you have in Kenya. So it's really interesting to hear your views. And it also, I think we may be speaking to each other more frequently. And I had maybe one question to you for later, but on the fiscal side of the Kenya in particular, with the deficit that is being run this year, but also with Kenyatta's agenda for his final 2 years in office. He has very high ambitions, I understand, on implementing his Big Four agenda. Some electioneering to be expected generally, and what impact that might have on debt and debt sustainability, and indirectly on the currency. But maybe we can leave that for later. Yeah, what I will do is very quickly introduce us, and then you will see what I will do. So us is TCX. We are been around for 12 years. We are a global derivatives business. We're also a development finance institution. The logos here are all our shareholders. Maybe go back if we can. Yeah, we are a mixture of 4 governments: UK, German, Swiss, Dutch governments, and then a wide range of development finance institutions. We brought all these institutions together 12 years ago and said, let's create one central vehicle that can operate as sort of the treasury function for all these shareholders when managing currency risk. By doing that, we create economies of scale, capital efficiency, and also because all these institutions lend collectively across the globe, by managing local currency lending activity of all these institutions, we organically and automatically have a very nicely diversified portfolio across 50, 60 currencies. And currency diversification is one of the key mitigants of our risk. Yeah, so what we do, now we can move on. What we do is we basically have a mandate to provide currency derivatives in the most illiquid markets. So we supplement whatever the commercial banks offer. I wanted to start off with making a distinction between currency risk and convertibility transfer risk. Niels pointed it out also. They very much deal and come across issues around conversion risk, the ability to transfer currencies from one country to the other, to convert local currency into dollars, to take dollars out of the country. That is convertibility risk. If we take the Nigerian example, so you can imagine these are old slides, but they still are relevant. If you look at the Nigerian case, 5-6 years ago, or no, it's 2015, 16, when the oil price collapsed, Nigeria, for its forex reserves, is totally dependent on oil revenue. So when the oil price collapses, their forex reserves dwindle, and then inevitably it leads to pressure on the currency. That led at some point to the Nigerian authorities releasing the peg, which was, they kept it artificially linked to the dollars. They could no longer support their own currency because of the dwindling reserves. They let it slip, and boom, this is what you see. And Niels made the point earlier that we are now in exactly the same situation in Nigeria. Very low oil price, dwindling reserves, inability to sustain the exchange rate peg, and a serious downward pressure on the Naira. This what happened, and when the currency peg breaks, and that's also the risk of pegs, important to bear that in mind. They provide a sense of false security, because when the peg breaks, the currency collapses with a big bang. That's what happened in Nigeria. That is currency risk. So the next slide. This is currency risk, meaning the shock can also be a gradual depreciation, or depreciation of the currency. If you have dollar liabilities, that will hurt you, and that's currency risk. That is the risk that we insure parties against. It's separate from convertibility and transfer risk, which we cannot manage. So the next slide. Also in the Nigerian context, as I just said, the reason that the currency collapsed to begin with was because there was a dwindling reserve capacity, or dwindling reserve of dollars in the country, and that led the Nigerian government to impose capital controls, basically rationing the little dollars that were left in the country, and rationing them and allocating them, with a priority to first the most essential industries, medication, health, etc. As a result, for people who were at the back of the queue, microfinance institutions, other small borrowers, they simply could not access dollars. So we experienced this a lot with indirect, our clients also, which were serviced by microfinance lenders, MFIs in the country, microfinance institutions in the country, couldn't service their debt because even Nigerian Naira loans are synthetic by nature. You still have to service them using dollars, a bit complicated, we won't go there, but they could not get those dollars in the market despite being completely solvent, having enough Naira, but they just couldn't lay their hands on dollars because they were at the back of the queue, couldn't convert Naira into dollars, could not transfer dollars out of the country. That risk is convertibility and transfer risk, and that's a risk that unfortunately we cannot cover. We have no presence in these countries. We are not in a position to secure hard currency any better than somebody else in the country. Just to make that distinction, what we can do and what we cannot do, and that these are two separate risks. Next slide, please. So this is just to say that currency risk, but also conversion and transfer risk, can be an issue depending on what capacity you have an interest in Africa. So just wanted to sort of recognize that there might be different types of roles represented in the audience. We understand that if you have a shareholding in an African subsidiary, or as a personal investment, you have invested in an African business, then your equity is by definition exposed to currency risk. It rarely gets hedged, but it is a possibility to hedge it. If you are an African business, or you're a shareholder in an African business that needs to attract finance offshore, abroad, from the DFIs or impact lenders or other international lenders, then the question is, should I borrow in dollars? And if I do borrow in dollars, can I then hedge myself, or can I borrow in local currency from somebody who can hedge the risk himself? All these questions. And if you're an importer, exporter, of course, if that's what you're doing, if that's your business in Africa, then you're also exposed to currency risk, but short term, which you might be wanting to hedge with short term forward. So to make the point, depending on who you are and what your business is in Africa, you will in some way, shape or form be exposed to currency risk and possibly also to conversion and transfer risk. Next slide, please. Because we want to have Q&A, I'm just going to blast through a few images to make a couple of points. To make basically one point and to illustrate volatility and how different markets also react to external and internal events. So I'm going to show you very quickly. You'll see 12 countries and currencies pass by. And what every image is the path of the currency relative to the dollar in the past year. And the red line represents the 1st of January. So just to show what the impact has been year to date. Of course, COVID plays a massive role, as Raphael was explaining, but there are other factors. If the graph goes up, it means that the local currency is weakening. So you see Kenya, Raphael talked about it, always been very stable, but for the first time in many years went through a bit of a shock early this year. Rwanda has a very well managed economy and is effective in having a relatively benign gradual depreciation path, but can also not fantasize away external shocks. Everybody gets hit by external shocks out of their control. In the case of Uganda, you see very pronounced the impact of COVID around March. Sudden depreciation of the currency, has recovered afterward. That is also to do with investor response, money fleeing out of the country, other sort of perception issues. Tanzania, we talked about it, doesn't look too shabby, has held up quite nicely. Next slide, please. So this is East Africa, Raphael's terrain. Looking beyond that, Mozambique is a country that only a few years ago went through a massive hidden debt scandal. It appeared to have been borrowing very, very heavily without sort of government consent, individual ministers signing up big loads of debt. That resulted in a massive shock to the currency. lost nearly 100% of its value in a matter of months, since matters have stabilized, as is evident by that graph. Zambia and Kwacha, I don't know if anybody here has been following Zambia much, but Zambia, we used to be a DFI multilateral darling, relatively stable performer, lovely country, few sort of structural issues along ethnic lines and that kind of thing. However, under the current government, I dare say, a lot of that has been lost. Fiscal policy is dramatic. Corruption has been rampant. Also here, hidden debt problems, borrowing from the Chinese without, just really a huge mess. And that leads to debt issues and to currency volatility. Currency is very, very fragile. The country is very, very fragile, is defaulting on its debt already, and is likely to continue doing so, as the IMF is kept out of the door because the government has no interest in the IMF looking over their shoulder for the worst possible reasons. It's a shame. Malawi is a country that puzzles me personally. There's a constant, the convertibility issue in the country is massive. There's a very cyclical economy. The dollar inflow depends on the harvest and the export of tobacco. So it's very cyclical inflow of dollars. There's a constant concern about getting access to dollars, but yet the currency is relatively stable. So it's a weird animal, but because we don't do so much business there, because it's so small, also my personal knowledge, and maybe Jos and Kevin know more, is quite shallow. But it's odd that that currency continues to be relatively stable. Botswana, the pula is pegged to partially pegged to the South African rand, partially unpegged. What can I say? I mean, that's a well-run country. And that is generally reflected in moderate hedge rates and a relatively stable pula. Next slide, please. Next slide. Anyone? Sierra Leone, moderate. Same story as Malawi, by the way. Not a country that is visited much by the DFIs. It's happening. So less known, I would say. South African rand. I don't know how close people here are to South Africa, but it's also, it's a big worry. It's just a constant worry, and there's lots of the SWOT analysis is a very extreme thing in the case of South Africa. You have massive opportunities, but there are also massive threats, and you wish that it will move into the right direction and not into the wrong direction. But it feels sometimes like it's out of control, and it's very, very worrying indeed. It's a country that we follow, of course, because it's important to the continent, but the financial system and the financial sector is very strong, very well developed. Hedging instruments are widely available. So it's not a country where we are required or needed. So we don't do business there, but we do follow the country naturally. Sadie, also interesting. You can see the big uptick post-COVID, sudden depreciation. And contrary to Uganda, for a reason that I also cannot oversee, but I'm sure Kevin understands, where you in Uganda saw that it recovered quickly. Here you don't see the recovery permanent. And then we were talking about the Naira earlier. It has gone through a bit of a shock due to COVID. And as Niels was pointing out, and I mentioned earlier, it's been a flat line since. But there's serious pressure on the Naira, and I don't know, and maybe Kevin can say, but we also generally follow what the black market rates are, and they are probably at the moment, I'm not sure, but I suspect that they're quite far off of this official exchange rate. So there's serious pressure on that Naira. And that is also reflected in our hedge rates. So that's the sort of yeah, the contradictory here, right? I probably need to shut up and stop talking. But you have a flat currency, yet very high hedge rates. Next slide. This is just to show in 1 second the depreciation year to date, and it runs from just 1% to about 30%. So these are massive depreciations and important numbers when you're considering, should I borrow in dollars at 5% or borrow in local currency 15%? Yeah, it's a 10% difference. That seems expensive, but if you look at these depreciations, you understand that that is not necessarily the case. Next slide, final slide. We don't need to talk about this, so we can skip this and move to Q&A.
Okay, thank you very much, Per. For the Q&A, I saw 2 questions already coming in at the Q&A box below, a couple of more coming now. Feel free to add your questions there. We had also some questions coming in via email from Medical Credit Fund. I'll share them with the rest in the chat function just because I cannot access the Q&A for some reason. They're quite long, so also I think the TCX and Medical Credit Fund can best get in touch to further discuss these questions. But for the moment, we will take the second one, which is, does TCX see companies opting for far out the money options to benefit from a smaller upfront premium, but still have the insurance or some downside protection in place should the African currency in question drastically devalue? Or in other words, can TCX also offer options there?
Evan.
Yeah, I
Kevin.
think Maloe can take this one. No problem. Hi, everyone. Thank you for your time today, and thank you very much to NABC and StoneX for this webinar. I think the question is a very interesting question. I think the short answer and the long answer. The short answer, I'll start with the, unfortunately, options TCX does not offer, and for many of the currency pairs we are talking in, particularly most of the African currency pairs. When I say currency pairs, so either the dollar versus an African currency or the euro versus an African currency, the option market is very shallow. In many cases, doesn't exist at all. And generally, options are a bit, one of the more complex hedging strategies. So that's we do not offer at this point. And yeah, it's very, very few participants offer it in across the board. But I think the question, the long answer is it highlights something very interesting, which is downside, mitigating your downside risk, as in limiting how much downside risk you have. And I think it's interesting because some companies have strict policies regarding currency. I mean, when I say currency risk, I mean particularly depreciation risk. And to manage this, sometimes essentially take out a hedge in a currency pair where we may see other clients say, yeah, this is too expensive. Or, but if you have some companies sort of have a policy, which essentially goes to what a question from Medical Credit Fund is saying, where the depreciation risk, they limit how much depreciation risk they are willing to take through a hedge. So, or they say we take no depreciation risk for transact a hedge, even if it seems quite expensive in the view of others. They will transact that hedge because they want to have absolutely no depreciation risk. And yeah, this essentially gives you the downside protection. Of course, it is, no one can predict the future, but you sort of have predictability when you do that, because you know if things are good, okay, it ends up looking like a cost, but like insurance, because hedging and currency risk protection, depreciation risk protection is often compared to insurance. It provides you that predictability and certainty, which is generally very valuable. And in this case, it's most valuable when you have taken it out previously and things go very bad. So with the graph Per showed earlier, essentially you see quite a few currencies have depreciated by more than 15 to 20% this year. If at the beginning of the year, maybe before anyone saw the potential impact of COVID-19, people, 30% depreciation or 20% depreciation in certain currencies may have seemed highly unlikely. And if someone was offering you protection, you may say, oh, I don't need it. But yeah, in unpredictable circumstances, which happen more and more, it is very critical. So I think, yeah, the question essentially, I would advise I think big companies do this quite a bit. They have whole policies and stuff, but I think small and medium enterprises, I'm not saying, oh yeah, immediately hedge now, but you definitely should assess your risk exposures of all types. So both depreciation risk, so depreciation risk, transfer risk, conversion risk, liquidity risk in a FX context via practical financial analysis, and then decide whether or not to hedge. But at the very least, I think the financial analysis is key, because I think a lot of small and medium enterprises may underestimate the potential effects of those changes on their supply chain and on their costs. I hope I answered the question well enough. And yeah, there are other questions, we can take them offline and answer in the interest of time.
Thank you very much for that, Kevin. Then now let's move to the Q&A box. I see the first two questions coming in from Peter Diekes, Rabobank. I will take the two together for the sake of time. First question, what is the minimum amount TCX is willing to insure? And second one, what about the African Free Trade Zone? Is there any news on this topic, and what would it mean for Dutch investors? That Kevin, well, for you as well?
I can take it. If you want to add anything, you can. Minimum amount TCX is willing to insure. There's quite a bit of variability there. So I think usually I would say lowest minimum ticket sizes on average would be about 500,000 euros. But yeah, it can be lower, it can be higher. It's quite dependent, but I think that's a general ballpark amounts. Please, I think our emails are in the presentation, and I don't know whether they'll be shared with the group, but we can definitely get back to you if you want more detail, because yeah, we're always looking to help. And in terms of the African Free Trade Zone, COVID didn't help. It is still ratified by majority of countries, is in the works. In terms of the effect for Dutch investors, if all this depends on the actual practicalities of its enforcement, because yeah, free trade agreements are very nice. For example, ECOWAS has a free trade agreement, but Nigeria's borders have been closed to imports and exports for some time. So these free trade agreements, the paper is very important, but it's also the practical aspect. And I think practically, if it comes into force as is expected, yes, the mobility of labor and capital is going to be significantly increased. Intra-African trade is really, really low. And that increasing should only increase growth, increase opportunities, because trading with, let's say, trading with Ghana and Togo, if you're a Dutch company trading with Ghana and want to do things in Togo, now it's very separate. Of course, the countries are not joining, but what will happen is to set up in one hub, the interconnectivity between that country and other countries on the continent should be much easier. But yes, there are many aspects to it. So I'll say we wait and see, and we analyze it as it goes. Okay, I don't know whether anyone has anything to add on that.
Anything to add on the question, Raphael?
Yes, so thanks very much, Kevin. I think you pretty much are spot on. So the African Continental Free Trade Agreement was signed sometime last year. It doesn't help, as Kevin outlines, that then we've had COVID. In at least globally is some semblance to a move towards economic nationalism, of course, given just the disruption around the supply chains that we've seen with COVID. And so that's the competing tension with free trade agreements generally at a conceptual level. So the momentum that was garnered in 2019, of course, we'll have to deal with this new reality about the inward-looking nature of a very dominant view that's beginning to emerge as a response to COVID. Still early days on how that debate will be settled. However, what's clear is the African Continental Free Trade Agreement, when it actually materializes, gives you the largest single market ever. So from a Dutch investor standpoint, looking outwards, looking into Africa, that's how you want to see it in terms of potential scale. But of course, the primary basis for it remains, as Kevin outlines, is improving intra-Africa trade in the first instance, which of course will also have ultimate efficiencies for broader Dutch sort of interaction at the economic level. So it's been disrupted, I would say, shortly, but we will be able to see with the reopening of countries, whether the African Union and all the players concerned will have the determination that we saw last year to get this to fruition. And that's, I guess, the color that I would add to that.
Great, thank you very much, Raphael. Then the third question is focusing on Nigeria, and it's also for TCX. How can smallholder or international business start up in Nigeria?
I see the question was to Per, but I can take it and Per can add something. As I think Per outlined, we cover particularly depreciation risk. In terms of Nigeria as a whole, assuming as Niels said earlier, yeah, there is a general consensus that there will be that the country cannot manage to control the currency for as long as it has. This is the general view you can find online, nothing particularly unknown. In terms of insurance, I know it's tricky because I think, yeah, with oil much lower, the country is trying the removal of fuel subsidies. They still attempt to remove fuel subsidies and electricity subsidies to help the government's fiscal position. Long term is good. The refinery that hopefully comes online in 2 or 3 years, the Dangote refinery, and I think Fulaki will know, that should help. But in terms of insurance, the capital controls and with the central bank controls dollars means the depreciation risk, which is a big macro factor that is, yeah, that cannot be managed individually. You can only try and mitigate the risk. And because of the way the CBN controls, the dollar shortages in the country have been, I mean, they've hit everyone from, I know Diageo, Nigeria during the crisis had a problem. I know a big World Bank backed power project. I think Azura Edo Power Independence Power Project also could not access dollars. So yeah, it's a difficult question in terms of how to do it. I think at least trying to manage the depreciation risk from our side is what we would say, via hedging, via assessing how much you are exposed to it and seeing what the best line is doing. But in terms of the convertibility and transfer risk, that is very tricky. Yeah, TCX is working on the Deliverable project in Nigeria to hopefully try and make it a bit easier, so it not only be depreciation, but some of we would, instead of a synthetic settlement, which is a bit technical, but essentially would have had a deliverable product where you can access Naira and send dollars, but that was a bit hampered by the current situation and everything. So long term, hopefully we could offer that, but yeah, at this point we don't. So yeah, it's a tricky one, definitely. From my answer, I guess you can see it's a tricky one. I don't know if Per has anything to add.
I think actually, for the sake of time, we should move to the next questions. I see 4 more in the Q&A box, which I suggest we actually take all answers. We might go 5 to 10 minutes over time. And any other questions coming in, I would suggest to take up the discussion after we end. The next question is, with multiple countries, we experience shortages of US dollars availability to get money out of the countries. What is your take on this, and what are developments regarding this, for example, in Cameroon?
Yeah, I can also take this one. I see the next one is for Raphael, so then maybe you can stop hearing me for a bit. Yeah, I think it's the same thing about the capital controls. Many countries in the region, sometimes there are legitimate reasons for some level of capital controls. So capital controls and reduced foreign exchange earnings, which COVID, of course, has not helped, which commodity prices falling have not helped, means that, yeah, in the short term, that's probably not going to significantly change. Developments generally in Cameroon, I cannot speak to Cameroon particularly at this point, and also because it's in the ZAF region is a bit of a different case because of the peg and the fact that the French government guarantees convertibility. But yeah, I think the shortages of USD is becoming a bit of a problem, and yeah, it's a tricky one, which is partly dependent on the country's external positions and central bank management.
Well, it comes a little bit back to the example of Nigeria that we've used a couple of times before now, right? So what do we see as developments in this? Well, there is not really an answer to it. What you see happening is that they're using a lot of their reserves, and they need dollars for this to make sure that the local currency remains on a, let's see if I get a call now, remains on a certain level just in order to protect, imports becoming too expensive and protect the local consumer prices. And if the oil prices keep being as low as they are, it's going to be very, very difficult to get access to sufficient dollars in order to do so. So I don't know what the real development is going to be around this. I don't see an easy solution to it either.
Okay, thank you very much, Kevin and Niels, also for that. Then the next question is for Raphael. Do you expect the drop in foreign aid or development going to East African or the Sub-Saharan African economy? And how do you think it will impact the path to recovery in 2021 and beyond? Have governments anticipate this in their future budgets?
Thank you very much, Maloe, and thanks for the question. A very good question indeed. So the United Nations Conference on Trade and Development just published its 2020 World Investment Report. They reckon that in 2019, foreign direct investment totaled about 1.5 trillion. They project that will slow down by half due to COVID. And of course, worst hit will be, as the questioner implies, will be broader frontier markets, including the EAC. What does this put? And I think first is to recall that in terms of the EAC 4 countries that I spoke about, the biggest beneficiary for the last 5 years of FDI has been Tanzania, followed of course just out of size by Uganda, and then Kenya comes third. Rwanda is pretty tiny, it's operating about just $310 billion a year on average, if you look at it that way. Now, with the, you have to, in order to understand the evolution of this path, I guess one has to take a view of the path of monetary policy at the global level. That's one variable to bear in mind. So we've seen the US Federal Reserve guarantee in terms of just forward guidance, holding on to the current path to almost for the next 2-3 years. So obviously you're having lower for longer monetary policy or zero interest policy, as it were, with us for a significant duration of time, which of course then away from just the capacity or availability question of the FDI component, will inform some of those asset allocation decisions, including how one faces potential opportunities here. Now, have governments factored in that? Certainly. I guess at the sovereign level, you've seen a significant conversation both at the AU House, or rather in terms of the AU caucus, but also just bilateral conversations by different sovereigns here, including the EAC for around bilateral conversations, including purchasing power agreement. For instance, in Kenya, I think you have just seen the president out in France, and there've been significant movements there. So there is a realization by all the sovereigns here that the budget deficit as projected, and which of course is only getting worse given the fiscal challenges I pointed to, will have to be met with new policy thinking and new policy. So the areas of FDI are frontal. In this year's budget for all four, of course, there was no mention or no reference to the actual number impact of that FDI withdrawal facing this territory. So of course, it has implications for external, sort of the region's external dynamics, and can only aggravate some of the currency or interest rate risk challenges that Per very eloquently went through with some of you. So the direct answer is it's the developing policy landscape is already, or is of course abreast of it. Whether or not there is a tangible policy response to replace that is of course still anecdotal, and for the most part it cannot be a positive thing net-net. So directionally we can agree on that, but yes, I guess like a lot of negatives coming with this new challenge, unprecedented COVID challenge, we'd have to take it as such and take it by day.
Thank you very much, Raphael. The next question is again from Peter Nikas, Rabobank. We talk a lot about the Anglophone African countries. How about the Francophone Africa? Could you tell a bit more about Senegal, Mauritania? Yeah, the current situation there.
Yeah, fair point about Francophone Africa. I think Mauritania, yeah, that do not have a lot of on-the-spot information and developments since COVID. I know there's been a bit of IMF help, as most countries on the continent have had. I think Francophone Afrique, particularly, I think the biggest story there over this year has been the introduction of the ECO, or the future introduction of the ECO, which is supposed to replace the CFA franc. That's a whole story on its own. So I won't talk too much about that, but I guess you probably already know. But yeah, essentially COVID-19 has sort of delayed the introduction of the ECO, because it's looked like it was going to be, without COVID-19, most people believe the introduction would have been much further along the path. But with COVID-19, the introduction of the ECO, which really is already was just essentially more or less a cosmetic change. Yes, there were some changes to the French essential control or management of the currency, but most of the changes were cosmetic. And now, especially with elections in Ivory Coast around the corner and COVID-19 factors, that transition is probably likely to take more time. And yeah, the ZAF countries, so the Central African countries, which can be quite dependent on commodities. Obviously, oil has gone down a lot and commodity prices are struggling, but generally there has also been quite a bit of help from the IMF's rapid financing instruments to many countries in the region. So I think that's a very short summary. If more is needed, we can take it offline in the interest of time.
Thank you, Kevin. Any of the other speakers have anything to add to that? Not for the moment. Okay, then we'll move to the last question. In the graphs that Per showed, most of the sub-Saharan African currencies have experienced a one-off devaluation due to COVID. If economies improve next year in line with baseline scenarios, would we expect a currency correction back to pre-COVID levels, or would currencies stay at current levels and gradually continue on their normal path? Example of the KES, which oscillated around 100 for the last 3 years or so, and now depreciated to 108. Kevin or Per, do you want to take this question? Kevin?
Well, I certainly can chip in as Per organized.
Yeah, sure.
Yeah,
go ahead, Raphael.
I think Raphael is more informed on this than me, so I'll definitely defer.
Yeah, so the Kenya shilling is a very interesting story. Number one is it's been very stable, in some parts the best performing of all currencies in the region for a while. And then you had this interesting spat with the IMF with regard to just Reuver recalibrating given the size of the economy, and there was a suggestion that it was almost acting out as a managed peg, in the sense that the central bank vigilance had kept it as an artificial level. Now that's the IMF version, which of course, as you'd expect, was rebutted very strongly by the central bank. What we've seen with COVID is a near consensus agreement that there's steady demand at a time when even in the best or performing period, the supply side seems to be weak. All right, so the supply side is notably agricultural exports. They've been the highest we've seen in the longest, but even still, it's still falling short. And then, of course, very steady remittances, averaging about $270 million month on month, and still rising. The demand side is equally very strong. In actual fact, in recent weeks, what we've seen is durable demand. The supply side cannot meet, and so we've seen that steady depreciation. I think the best way to have, because you're asking pair for a longer term view into 2021. I mean, he'll have you know that forecasting currencies with that time horizon is almost folly. But I think the only thing you can actually infer is you go back to the external dynamics. So you go to the balance of payment position of the country. And if you look at the current reserve position, for instance, you're having on average just slightly above 5 months of import cover, which is both above target for the EAC region, but also just the country's statutory obligation. So that's a good thing. The current account has improved remarkably and is projected to close at just 5.2%, which is decent given just historical performance. And then, unlike what was feared before, the key export areas, which is horticulture and agriculture, particularly tea, have done very well on the back of fairly improved agriculture. So what we can guarantee is that obviously, in order to balance the new realization from domestic priority level, and that means you have to take a view on your inflation, you have to take a view on your interest rate environment, that fiscal outlay that I was trying to belabor, and what have you. So those domestic challenges, in order to balance them with the external environment, you would have to agree that even with a vastly steady and fairly fundamentally strong balance of payment dynamic, there needs to be some depreciation of that currency in order to align those two sectors, as happens in traditional macroeconomics, or open market macroeconomics. So be that as it may, do we see 110, or because you're at 108 and actually we're at 109 as of this morning, 109, 109.50. And I think it's just a matter of time before we hit the 110. Now, the IMF model that I spoke about was suggesting that 117 seems to be about the right level for the Kenya shilling against the dollar. It's a long path to that level. I cannot say with certainty that we don't see a depreciation to that point. What I can say, however, is that there seems to be a policy determination and vigilance at the central bank level to manage the currency's almost guaranteed depreciation with a very, very, very steady hand. And they have the sufficient war chest in terms of results to be able to deliver on that. So stability can be delivered. What we cannot point to is a particular number. And keep in mind, by the way, that and Pa alluded to this, the currency is just a price like any other, and it's a relative price, has implications for the country's inflation metrics, and therefore, if there is any singular policy priority, managing the shilling stability through into 2021 recovery is something that will be top of mind. And then just in closing, I think Per asked me a question, Maloe may have forgotten, around Kenya's debt sustainability concerns, elections, Kenyatta's bid for agenda, what have you. I will say number one is obviously into 2022, which is when Kenyatta's term comes to an end. We've had an early commencement of the Kenyatta succession, if you'll call it that. And so we are seeing a rising political noise, especially because there is a small implosion or civil war, if you'll call it, within his own administration, his own party. So the Jubilee party, there is a bit of a tiff between him and his number two. Of course, everybody is positioning themselves for to succeed him, and that is, of course, informing a lot of political rhetoric, which, of course, we have to admit will sort of take away attention from more needful macroeconomic policy focus around the Big Four. It doesn't help that the fiscal capacity to deliver on the Big Four itself as the agenda is already strained on account of COVID. So very eager to deliver on his legacy, with a restless deputy seeking to succeed him, some sort of rapprochement with the opposition, and you don't know what sort of deals were done there and what sort of dispensation we have. I think the political risk environment is, frankly speaking, going to heat up a little into 2021 and is potentially disruptive to that macroeconomic outlook that seemed very positive on my analysis. I think you'll have to factor in those sort of dynamics, and that has, of course, implications for perhaps a little bit more volatility on the shilling side if you try to factor in some of the things that we've been discussing here. So that's pretty much how Kenya looks like. And yes, I think for those who are watching the region, because it is the largest economy in EAC, I think you ought to start paying attention to some of the points that Per was hinting at with that question. Thanks.
Great, thank you very much, Raphael, and for answering both questions. Indeed, also the one asked by Per. Yeah, before closing, I just wanted to give the floor once more for some final remarks to all the speakers. If there's anything else you want to share with the participants today, starting with Niels.
Yeah. So
Yes.
no, just want to thank everyone for joining today's session. I think well, we had a lot of interesting topics that we spoke around, and although it is quite versatile, you know, speaking about currency risks, as you can see, it's definitely there is a wider interest on the long-term risks, which of course makes sense. But again, I just want to emphasize once more that there is also a risk on the short term, and there's a lot of interesting things. And again, if you ever want to have a conversation around these topics, just reach out to me after this webinar. More than happy to have a conversation. So thank you all again for joining this webinar.
Thanks, Niels. Then moving to Raphael. Anything last comments to add?
No, just to echo Niels' point, and thank you, Maloe, for moderating. Thank you all very much for your very pointed and very useful questions. I've definitely enjoyed the conversation. I think my fellow panelists have given us a lot of color on how to approach the coming days to closure of 2020, but also to begin positioning whatever business priorities we have into 2021, which will undoubtedly be on a recovery mode. And just to add that, look, whichever scenario one takes, there is no doubt that there will be a return to some level of activity. We can disagree on whether it's 80%, 70 or 90. The reality is that with living with the virus and potentially managing it will, again, just the human spirit will, is determined to come back. And so the animal spirits, as we like to call them in traditional economics, will slowly awaken. We should inform that recovery path that we have. And I think there is potential, subject to managing those risks, there is lots of potential opportunity for investment into the broader territory. I think it's fairly diversified. And if you're looking at sub-Saharan African numbers broadly, I think the EAC will remain the powerhouse that I called it in terms of powering the broader African recovery numbers. So thank you very much. It was a pleasure to be on this panel.
Okay, that is it. Thank you very much, and have a great afternoon, everyone.